In 1997, entire economies collapsed in a matter of weeks. Currencies lost over 50% of their value. Stock markets were wiped out. Millions of people fell into poverty almost overnight. And it all started with one country that insisted everything was stable. This is the story of how a single crack in Thailand's financial system triggered a chain reaction that nearly shattered global markets, and why the same pattern could happen again. In the early 1990s, Southeast Asia was the pride of the global economy. Thailand, Indonesia, South Korea, Malaysia. They were called the Asian Tigers, fast-growing, export-driven, unstoppable. Foreign investors poured billions of dollars into the region. Banks borrowed heavily in US dollars. Real estate boomed. Stock markets surged. Everything looked perfect. But underneath the surface, something dangerous was building. Many of these countries had fixed their currencies to the US dollar. That gave investors confidence, stability, predictability. But it also created a trap. Because if confidence ever cracked, they couldn't print US dollars to defend themselves. And that's where the domino began to tilt. Thailand was ground zero. Throughout the early 90s, Thai banks borrowed massive amounts of US dollars. They used that money to fund property developments and risky investments. But there was one problem. The money they borrowed was in dollars. The money they earned was in Thai baht. As long as the baht stayed stable, this mismatch didn't matter. But if the baht weakened, debt would instantly become more expensive. By 1996, cracks were forming. Real estate projects stalled. Exports slowed. Investors started asking questions. Then hedge funds began betting against Thailand's currency. And Thailand tried to defend it. They burned through billions of dollars in foreign reserves, trying to keep the baht stable. But markets are brutal. On the 2nd of July, 1997, Thailand gave up. They floated the baht. It collapsed immediately. And that's when panic spread. Once Thailand fell, investors looked at neighboring countries and saw the same weaknesses: high dollar debt, overheated property markets, artificially fixed exchange rates. Malaysia was next. Then Indonesia. Then South Korea. Currencies fell 30%, 40%, even 80% in some cases. Indonesia's rupiah collapsed so violently that food prices exploded. Riots broke out. The government fell. South Korea, one of the world's largest economies, had to seek an IMF bailout. This was no longer a regional problem. It was global. US banks were exposed. European institutions were exposed. Hedge funds were collapsing. One fund, long-term capital management, nearly brought down Wall Street in 1998 as a result of contagion effects. The domino had crossed continents. This wasn't just numbers on a screen. Over 20 million people fell into poverty across Asia. Unemployment surged. Entire middle classes were wiped out. Countries that had been celebrated as economic miracles suddenly became cautionary tales. And the irony? Many of them had strong growth but weak financial structures. Growth hid fragility. The International Monetary Fund stepped in with massive bailout packages. But those bailouts came with strict conditions: higher interest rates, spending cuts, economic reforms. In some cases, these policies deepened recessions before stability returned. It took years for the region to recover. But the real lesson wasn't just about currency pegs. It was about leverage, confidence, and how quickly global capital can reverse. Now here's the uncomfortable part. Today, global debt levels are higher than they were in 1997. Emerging markets still borrow in foreign currencies. Capital still moves instantly across borders. And when confidence shifts, it shifts fast. We've seen echoes of this pattern. The 2008 global financial crisis, European debt crises, Currency collapses in emerging markets. The structure changes. The vulnerability remains. Because financial systems are built on trust. And when trust breaks, dominoes fall. This is Neto the Creator. Follow for more.